Hello and welcome to Livewire's Buy, Hold, Sell. I'm Ali Selby and today we're going to be taking a look beyond the boring banks and miners for a little bit of growth for your portfolio. To do that, we're joined by James Gerrish from Market Matters and Henry Jennings from Marcus Today. It could be argued that the Aussie market is just as concentrated as our US peers, although ours is concentrated with banks and miners and not tech giants. Henry, do you see any problem with that? Is there any risk involved in that? And how do you navigate that?
Ali, there's a huge amount of risk in that, and we're seeing it. You know, Commonwealth Bank is now the biggest component of the ASX. It's also the most expensive bank in the world. I mean, it's just gone from strength to strength. It has been extraordinary. So that there is this problem, and I guess, you know, we've seen it in the US with Nvidia and other stocks like that, is that the popularity of these things drives them possibly beyond their rational valuation, but it doesn't really stop them going higher and higher. So there is inherently a problem because I guess at some stage the index funds and the ETFs just keep piling in, and it just becomes self-perpetuating. So when it bursts for whatever reason, it can be quite violent and can upset a lot of investors.
Okay, over to you, James. Do you think CBA is the best bank in the world, as Henry suggested there? And is there any problem with having a super concentrated market?
Well, the market's always right. So you waste a lot of money trying to fight the market would be the first thing I'd say. We are as concentrated as the US, probably more so. 30% of the S&P 500 is made up of 7 stocks. So that is a very, very concentrated mix. We're a little bit more broad than that. Ours are, as Henry made mention of, financials and resources. That in itself, if I was sitting back and thinking about risk to an index, obviously the edgy technology companies being such a dominant player in the US probably creates a little bit more risk than what we're seeing in our market.
But ours are far more cyclical.
They are. I guess from they've got different drivers of their earnings, perhaps would be one way of saying that. I mean, banks are very economically exposed. There's no two ways about that. They obviously, it's about lending money and then collecting that money back and making a margin in between. So, if the economy starts to improve or doesn't splutter like perhaps a lot of people are expecting, then banks will stay well supported. I don't think the banks are a huge risk at the moment. I think the sector up 30% is pretty eye-watering in a short amount of time, but there's probably some reasons for that. So, it's a risk, but markets are all about risk and managing that risk. It doesn't mean your portfolio has to have such a dominant position in those sectors.
We've seen this great rotation, or everyone talking about this great rotation in the US. Do you feel like we could see that also happen in Australia?
So if we're talking about the rotation out of large caps into smaller cap companies, so yes, it can happen in Australia. I think that the one thing I'd flag is that the composition of the mid-cap, small-cap indices over in the US is slightly different. So they're dominated by economically exposed industrial companies. So the Russell 2000 is 20% industrials. They've got healthcare and real estate, etc., up the top of the pile. We've got ours are dominated by resource stocks. So yes, it can happen. I think it can happen because of one commonality is around cost of capital. So if cost of capital comes down, these smaller companies require more capital to grow. That's a commonality across the two, but I think you've got to be a little bit careful around not just extrapolating what's playing out in the US from a US market's point of view and saying we're going to mirror that here in Australia.
Okay, Henry, do you think the cost of capital can come down?
I think the RBA would be pretty foolish to do anything, to be honest. I mean, there's an old Yorkshireman's expression, if in doubt, do nout. And I think that kind of sums it up really for the RBA. There's no marks here in crashing the economy. They can see things are slowing. We know things are slowing down. So that's maybe anecdotal, but we're now starting to see it in some of the numbers coming up in the CPI. So I don't think we're going to get a rate rise. I don't think we're going to get a rate cut anytime soon. It's going to be on hold for longer. As far as our small caps go, as James says, the composition of the US Russell 2000, for instance, is completely different to our own ASX small cap index, completely different. And their idea of small caps is kind of our idea of big caps. They're almost ASX 50 companies, they're small caps. So it doesn't really filter through. Ours tend to be, as James says, a bit more resource-based, a bit more speculative. Telix Pharmaceutical is the biggest component of our ASX small cap index. So, that is a very different kind of proposition to, I think, Super Micro is their biggest stock. So I don't think the great rotation is going to happen here to the same extent. The bigger question, I guess, is this bifurcation of the market between resources and between the banks. And that is the interesting one for me, is to when do you buy resources? It's still too early, but that rotation is going to be quite interesting, I think, to see, because it wasn't that long ago, back in May, I do this thing called the big bank basket and the big miner basket, which is pretty rudimentary, just adding up the share prices of the 4 banks and adding up the share prices of the 3 big miners. And they were, when I started this, they were $100. You could buy 4 banks for $100 or 3 miners for $100. Now the banks are 230, the miners are 180 odd, and in May they were the same.
Right.
So that is the interesting one. It's too soon to do it, but that is the interesting trade, I think.
How are you positioned though? Are you overweight or underweight the banks? And how are you positioned with the miners as well? Are you overweight or underweight compared to the index?
I think it's very difficult to be underweight the banks because they're such a massive part of our index. It's called the widowmaker trade for a reason, because it can make a widowmaker of you. So unless you've got a compelling reason to be underweight the banks, I think you just have to, market weight kind of feels like underweight. You're not taking a big bet. They are, after all, building societies. I mean, they're pretty stable earnings. They're not growth companies. They find it very hard to grow. It's not impossible for them to grow at big rates, but politically, you don't want to put a big target on your back and say, hey, we're making a fortune out of everybody. They do it kind of slowly and by stealth. So I think neutral in the banks. Miners underweight at the moment, but looking at some stage for that rotation to happen.
Okay, over to you, James. Are you underweight and overweight the banks and miners right now?
So banks depends what portfolio. Income-focused portfolio is pretty much in line with market weight. Plus we've got some exposure through hybrids and direct bank bonds. In growth portfolios, then underweight the banks. I don't think you're going to get the growth from here that you can get elsewhere. Miners, overweight. So I have I tend to invest in portfolios against the grain. So I like the contrarian calls, not just to be contrarian's sake, but I think we've had a huge re-rate lower in resources. Obviously, some commodities are doing well, some commodities are doing not so well. A lot have been sold down pretty aggressively. So I think now's the time to be going long miners. I think for the next 12 months that's going to be a great trade. I think the areas that I would focus on, gold as a hedge, I think we're going to still see a lot of instability. That's probably a given. Uranium, copper and coal. So for various supply demand dynamics across those areas, that's the areas we're focusing on. It served us well probably 6 months ago. In the last 6 months it hasn't served us so well, but it's a theme we're still backing.
Okay, that was going to be my next question, a theme that you're really excited about for the next 12 months. Do you want to pick out one of those commodities and talk a little bit about it?
Yeah, I think I'll target copper. I know it's a theme that everyone likes. We know that copper is going to be key in decarbonisation. We know that the likely demand over the coming years is not going to be met by the supply that's being ratcheted up. So, to me, I can't see a lot of downside in terms of copper. The one, cautionary note a few months ago was that everyone was long, everyone was bullish. We've had that sentiment unwind pretty aggressively. Copper prices have gone from above $5 a pound to now testing $4 a pound. Our copper company on the ASX, and it's, we've got such a small area of pure play copper companies. Sandfire has gone from 10 down to low 8s. There's some other interesting copper stocks that are in the more junior part of the area for more, riskier, more leverage plays. BHP is testing $40. So to me, those are really good risk reward entry levels into a thematic that's going to be in play over the coming years. So copper I'd highlight as my number one theme.
Okay, over to you, Henry. What's a theme that you're really excited about over the next 12 months? Hopefully it's not copper, so we can have a little bit of something different.
It's not copper.
Okay.
It's not copper, but I do appreciate the theme. I've got to say, BHP as well, going in buying another copper company recently, not as big as Anglo, but they are making moves again there. So it is a big theme, but I think maybe people got a bit carried away. The one I like, I guess, and this plays into the US election. Donald Trump, the weakening of the US dollar, which both he and JD keep talking about in terms of trying to get that US dollar down and make America competitive again. I'm not really sure that's going to work, but gold for me does hold some potential. You know, the guys at Shaw have got quite bullish assumptions on the gold price going forward. So I've been looking at, well, the one that's caught my fancy is Bellevue Gold, which recently has done quite a large capital raise. The stock was, you know, flying $1.80. They did a capital raise of $1.55, raised $150 million, not an insignificant amount of money. Trading, you know, as with all these things, when we see these capital raises, it takes one little crack and all that fast money just disappears. And I love it the way they talk about it was such a successful placement. Well, it wasn't that successful. The stock drops another 10% after it was placed, and the poor old shareholders long at $1.80. You know, the stock's trading at $1.40 now. So it wasn't very successful from a shareholder point of view. But that bout of indigestion, I think, provides an opportunity to get into a quality gold producer. It is a producer now with a good 5-year plan, the all-in sustaining cost coming down at a kind of a knockdown price. And the bullion price is still very, very high.
I know before we talked about not wanting to bet against the market, that the market is always right. I'm going to push you to actually do that though. What's a big miner or a bank that you would rate as a sell, a strong sell today, and why?
Oh, a strong sell today. I think James is right. It's very hard to get very bearish on the BHPs, the Rios, and the Fortescue. We've seen Fortescue take a bit of a tumble due to that block trade. I think really at the moment it's maybe in the oil and gas sector, maybe the likes of Santos. It still remains problematic. I think there's still question marks over Santos. Woodside doesn't seem to be able to get off the mat either. So if you were going to avoid a sector, I think the oil and gas sector is probably the one that I would avoid for the time being anyway.
Okay, over to you, James. What bank or miner would you be selling today?
I wouldn't be selling miners because I'm bullish in that area. I think they've been, a sell is all about price, right? The miners are priced pretty cheaply at the moment. There's not a lot of optimism built in. I think one area that's got a lot of optimism built in is NAB. We own NAB, so I'm talking, we've still got it. So, but thinking about that thesis around, the business bank is what's driven NAB. NAB is up 34% in the last 12 months. ANZ's up 11. The rest of the banks are up about 30. One of the jewels in their crown is their business bank. CBA is a huge Goliath in the banking space. They're going hard at business banking. So it's the first time that NAB's had a really serious competitor in the business banking space. So when I think about how we want to position our bank holdings moving forward, then that's coming up on my radar as the one to sell, albeit that we own it, but we may well sell it very soon.
Get on that phone quickly.
Yeah.
Okay, well, I hope you enjoyed that episode of Buy, Hold, Sell as much as I did. If you did, why not give it a like? Remember to subscribe to our YouTube or podcast channels. We're adding so much great content just like this every single week.